Good morning. This is Japanese Economic Review Channel. Today, we review the historic events of yesterday, Friday, July 24th, when the Nikkei 225 suffered a massive 1,811-point plunge. This shocking Friday was driven by a violent confluence of geopolitical tensions in the Middle East and a sharp correction in global tech valuations. We will analyze the data to separate macro-driven panic from the underlying micro-realities of the Japanese corporate sector. Reviewing yesterday's closing numbers, the Nikkei 225 finished at 64,611.15, down over 1,800 points. Topix also dropped 42 points, ending its three-day winning streak. This followed a heavy retreat in the U.S. markets, where the Nasdaq plummeted by over 550 points. Notably, the yen remained stable at 163.73, indicating that the selling was a direct flight from equity risk rather than a currency-driven move. The primary catalyst yesterday was the sudden escalation in the Red Sea. Pro-Iran Houthi rebels attacked a Saudi tanker, sending crude oil futures soaring and reigniting inflation fears. Consequently, U.S. 10-year Treasury yields rose, putting immediate valuation pressure on tech giants like Alphabet and Amazon. This global risk-off sentiment cascaded directly into Japanese semiconductor and AI-related stocks. Looking at yesterday's intraday action, the market hit its trough at 1:03 p.m., with the Nikkei down a staggering 2,221 points. Despite the panic, the record trading value of 8.4 trillion Japanese yen suggests significant activity. While 877 stocks declined, 632 managed to gain. This high volume, combined with mixed breadth, points to a sophisticated sector rotation rather than a total market exit. Yesterday's performance matrix showed a clear flight to quality. High-beta tech and export sectors, including Advantest and Tokyo Electron, were hit hard by rising yields. Conversely, 11 sectors rose, led by defensive pharmaceuticals like Takeda and energy stocks like Inpex, which directly correlated to the oil spike. This divergence highlights capital seeking refuge in inflation-hedged and recession-resistant assets. The Growth 250 index also faced heavy weather yesterday, approaching its January lows in tandem with the broader market weakness. Major names like Cover and QPS Holdings saw significant drops. Even Tier 4, in its third day of listing, initially hit a new high before being overwhelmed by the selling pressure. This underscores a heightened sensitivity to risk across the entire startup ecosystem yesterday. Away from the index carnage, yesterday's corporate news showed continued B2C momentum. Fast Retailing announced a Shinjuku-exclusive Warhol collection, and Hagoromo prepared its Hagoromo Sario brand launch. From Zensho's steak fare to DIC's new health supplements, the micro-engine of the Japanese economy remains surprisingly active, suggesting resilient domestic demand despite the macro volatility. In the industrial space, yesterday brought news of critical long-term investments. Nippon Steel installed new tsunami barriers, and Hitachi Construction expanded its mid-size loader lineup. Sony also debuted its latest cinema line camera, the FX5. These developments remind us that infrastructure upgrades and R&D cycles are often decoupled from the temporary shocks seen in the equity markets. To summarize yesterday's events, we witnessed a sharp divergence. The macro shock was a reactive price correction to global instability and rising interest rates. However, the micro persistence of corporate Japan remains intact, with steady product pipelines and robust operational health. For the long-term observer, yesterday was a lesson in distinguishing temporary market noise from long-term corporate execution. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.